So, you've decided to invest some of your earnings, but you're unsure which monetary plan to use, investing or trading. For example, two athletes register for a race. One runs at a steady, comfortable pace until the finish line. The other alternates between sprinting and walking intervals. It's tough to forecast who will win, just as it's difficult to determine which strategy will be successful between trading and investing. There are many videos on siding with one monetary plan, but I'll explain how and why both options are good for you. If you have the same query, this video is for you. Hello 101 community, welcome back to our YouTube channel. The video is about the difference between trading and investing. Before we begin, if you're new here, make sure to subscribe to our channel and turn on notifications to never miss any updates. Now let's start. Correcting the fundamentals when discussing how to profit from the stock market is critical. The distinction between investing and trading needs to be made because it is frequently unclear. A trader is impacted by the ups and downs of the market securities. In contrast, an investor holds a position or security for a longer time and is a long-term player. The language and the meaning of how money moves in the market change frequently, and there are many variances between them. What is investing? The purpose of investing, which is a long-term strategy, is to progressively increase wealth over time through investment strategies, including mutual funds, purchasing and selling a portfolio of stocks, bonds, a basket of stocks, and more. Unlike trading, investing is a long-term commitment with benefits like interest, dividends, stock splits, and many more. Additionally, since prices are always expected to rise and investments are made over a long period, the risk of downtrends and market fluctuations is eliminated. That's why investors don't need to worry about specific market fluctuations. They last for only a limited time before the trend changes again. Investors are more focused on the fundamentals of the market than on the daily changing upward or downward trends. Long-term investors are more interested in market fundamentals, like the price-to-earnings ratio, the PE ratio. What is trading? Trading is a short-term and dynamic practice that entails repeated transactions based on market trends. Compared to lengthy transactions involving bonds or mutual funds, it's very brief. Stocks, commodities, currencies, forex, and other financial instruments are typical examples of trading. More profit is a benefit of trading than investing. If long-term investors receive, say, 10 to 15% of the profit annually, a trader might receive, depending on their choices and actions, the same 10 to 15% monthly. But that's not all. Trading is also dynamic and unpredictable. It's a high-risk method of making money where the market's direction directly impacts the trader's income and losses. The primary rule of trading is to purchase when the price is low and sell when the price is high. Still, there are several additional tactics such as reverse trading and short selling that only seasoned traders utilize to generate large profits in the short term. Such tactics are dangerous and not advised for novices. The difference between trading and investing. Trading is typically carried out by those who engage in intraday trading and are constantly on the lookout for growth investments using technical analysis tools. They foresee the upward or downward movement. On the other side, investors look for value investments and keep their money in place for a long time. Since there is no hedge against this kind of transaction, the risk in a trading strategy is very high, and there is no downside protection. On the other hand, a trader may have a properly balanced portfolio in which the downside of another offsets the upside of one asset to protect against losses. Large levels of trading activity typically cause the market and index movement. Therefore, in this case, traders, rather than investors, play a significant role in influencing market prices. Traders perceive the upside or negative differently. They employ various trading techniques such as the butterfly, short sell, long straddle, strangle, and many others. In contrast, an investor employs a standard and straightforward method to keep the asset while investing. Since buying and selling transactions occur daily, trading returns can be quite erratic and quick. To receive substantial profits, an investor must wait a while. Trading and investing investment approach. The technique used in investing and trading is a key distinction between both. In trading, technical analysis is used, whereas in investing, the investor uses the fundamental study of the company. The business's financial analysis, prior financial records, industry analysis, and overall industry performance based on the macroeconomic conditions in the country are all included in the fundamental analysis. Technical analysis studies periodic financial trends, such as the company's success in terms of numbers based on daily market uptrends and downtrends. As the company makes financial decisions reflected in the charts and data on the stock market, the traders must examine the company daily closely. By analyzing volume, price, and moving average movements, this data enables traders to make insightful forecasts about future changes. While investors meticulously examine the company, invest in it, and keep it for a longer time to generate a return with less risk, traders must act quickly and purchase or sell based on current trends. The differences between investing and trading based on time and risk. The amount of time spent on the two market-based financial investments varies. To invest, one must carefully research a company and hold it over an extended period, in the hope that it will generate profits over the long term. This form of investment has less risk and may not generate large profits. However, it is still reasonably safe regarding market trends. Mutual funds are a traditional investment that entails lower risk and profit. Bonds and stock baskets for extended holding positions are more examples. The temporal frame is less dynamic and might range from years to years. The market trend that lasts for a shorter time has little bearing on investors. Trading actively examines businesses and current patterns to foresee future changes that could increase profitability. It is a short-term investment, and depending on the state of the market, it may require purchasing and selling within a single day, weeks, or months. Since the market is unstable and one bad choice can result in significant losses, there is a high risk to reward ratio. The stock market is a famous example of trading. A trader buys a specified amount of stocks at low prices and sells them at high ones to make significant profits. In addition to enabling speedy transactions, this timing strategy also increases profits for traders relative to long-term investors. If you like the video so far, press the like button and subscribe to the channel. Also, if you want to develop yourself financially and want to take your future into your own hands, check the links in the video description. Now let's talk about the basics of trading. To make quick money, trading entails quickly purchasing and disposing of stocks or other securities. Investors often think about years, whereas traders consider weeks, days, or even minutes. Day trading and swing trading are two of the most popular types. Day traders seldom hold holdings overnight. They buy and sell a security during the same trading day. Contrarily, swing traders invest in assets they believe will increase in value over the next few days or weeks. Even if a stock's value is predicted to increase over the long run, it doesn't follow that it will do so shortly, or even in a few hours or days. Because of this, traders frequently base their trade decisions on news reports and technical analyses of market movements. Trading can be a dangerous endeavor. You risk losing a lot of money if a trade goes against you. Additionally, traders frequently enhance their risk by utilizing leverage, which is when they borrow money or purchase assets using cash they do not currently have. Leveraging can be done through options, margin trading, or short selling. Unlike the little guy, famous traders frequently seem more knowledgeable and skilled. Furthermore, while it's true that some traders are better at reading charts and carrying out technical analysis, nobody can predict every transaction with complete accuracy. Even famous traders have experienced significant transaction losses. Taking small position sizes, i.e., without investing a large sum of money, will lower your risk of suffering significant losses on any trade if you're interested in giving trading a try. Setting a stop-loss order that will automatically execute if the asset drops below a specific price is one of the other advice items, thereby limiting your losses. What are the basics of investing? Investing entails placing money into a financial instrument you anticipate will appreciate over time. Stocks, bonds, mutual or exchange-traded funds, etc. Investors typically have a long time horizon and prefer to grow money through compound interest and gradual appreciation over short-term gains. The chance of losing money on investment increases with the length of the time horizon. Because of this, the Office of Investor Education and Advocacy of the Securities and Exchange Commission, SEC, advises preserving money if you need to access it within 3 years. Investment returns could be far higher for all other objectives. Some investors may even have long-term plans for their assets. Investors should diversify their portfolios to lower risk, mostly by minimizing the consequences of volatility, rapid, violent, or unexpected changes in value or price. Through mutual funds and exchange-traded funds, ETFs, which are individual investment vehicles containing a variety of or a large number of assets, investors can instantly diversify their holdings. When choosing the asset mix for your portfolio, it's crucial to consider your risk tolerance and anticipated withdrawal date. If investors choose certain stocks or bonds, they'll often consider fundamental indicators, which are the issuing company's characteristics that are intrinsic to its operations, such as earnings, history, or creditworthiness. These elements assist in identifying inexpensive stocks, value investing, or have the potential to see considerable capital growth, growth investing. What is the best option for you? The answer is incredibly individualized, much like most things in the stock market. Some people find that longer holding periods work better when using a more fundamental strategy. In contrast, others prefer a shorter approach that allows them to be more aggressive with account creation and capital preservation. Despite the complexity of the holding period argument, stock selection will ultimately determine your level of success. Because of the compounding impact, picking strong stocks and holding them for a long time will allow you to accumulate significant wealth. Poor stock selection will cause compounding to work against you over several months or years as you sit on underperforming assets. The major advantage of shorter-term trading is the opportunity to use price action in your favor, far more than with longer-term trading. Most of the time, stocks are not valued effectively, which results in price turbulence that constantly produces changes. Instead of stock selection, the secret to successful short-term trading is opportunity recognition and sound money management. Thankfully, you're not forced to pick between the two methods. Both long-term investors and short-term traders are possible. Utilizing both strategies has the advantage of providing diversification. Simply put, diversification serves as a means of lowering risk. Typically, the idea is to hold a mix of different stocks so that no one stock can result in a significant loss. Another strategy for lowering risk is diversification by time frame and aesthetic. While short-term trading reduces the risk of making bad stock selections and the threat of a bear market, long-term investing helps to avoid the risk of impatience and impulsivity. It's not easy to use both strategies while trading stocks. The main danger is style drift, in which transactions develop into investments and investments into trades. The need for clarity cannot be overstated. Various brokerage accounts with different approaches can be quite helpful. Dividend reinvestment accounts, sometimes known as DRIPs, have housed some of my best long-term investments. The automatic reinvestment of dividends has a significant compounding effect over time, and the shares in the account cannot be exchanged as readily. Technical factors tend to be less important in longer-term investing than fundamental factors. The objective is to hold good stocks through good times and bad, and have faith that their superior attributes will be rewarded for years. These long-term investments can also be excellent trading vehicles since the fundamentals lend some assurance to a trade mostly driven by price action. The biggest risk of long-term investing is that you overlook weak price activity due to faulty fundamental analysis. All investment decisions revolve around this, but it may be managed by setting up longer-term technical guidelines. You may always repurchase the shares, even if you end up selling a long-term investment because it has reached an unavoidable loss threshold. The crucial point is that we can never be certain that our interpretation of long-term fundamentals is accurate. Combining trading with investing has many advantages. However, as with most things in life, only when you put some effort into it will it work successfully. The idea is to be methodical and have a clear strategy. One of the biggest mistakes people make when investing for the long term is being impatient or terrified of market cycles. By concentrating on trades and leaving your excellent investments alone, you can reduce the pressure to act if you're also utilizing a trading strategy. Using both methods makes patience stronger. I aim to assist you in creating your unique approach so that you can profit from trading and investing. You decide what method is best. That's all for today's video. I hope you enjoyed it. If you want to see more videos like this, subscribe to our channel and click on the bell icon so you'll be notified of every update. Also, don't forget to check the links in the video description. And while you're here, I'm sure you want to continue on the path of financial education. Click to watch the video appearing on your screen right now. I'll see you there. Take care and stay tuned.